Good morning.
Good morning.
411. How are you? Good morning, Kevin Casey, my co-host. I'm Audrey Boissonou. Good to see everyone. Thank you for joining us.
It's a big day today.
What?
Big day today.
Oh my God, it's always a big day, isn't it? Like, doesn't it seem like there's always something? But today is bigger than most days. And why would that be? One asks oneself. What happened today,
Some
Kevin?
announcement was made just a little while ago.
And what was that announcement?
Well, this is like for a couple more people to come on board here.
Okay, well, they're loading in. It takes a minute, right?
Yeah. It's, Fannie and Freddie came out with their new conforming limits. So our contest is done.
That's right. Which, by the way, we had such amazing participation. Almost 100 people weighed in on what they thought the new limits were going to be. And we had some really good guesses, didn't we?
We did have some really, really good guesses. Some people a little bit off. Some people, I would say half the guesses were under 4. Would I forget?
Oh my gosh. Nobody wants to hear your analysis of
under 706 was half the guesses were under $706,000.
Okay, but the way that you and Kevin Peroni were talking about this a couple weeks ago,
yeah,
everyone thought it was going to be 700 or 698.
Yeah, he called me to pick my number. I had a range, and he kind of freaked me out so much that I picked the lower of my range when I had already entered a number in the system that, boy, that was so close.
Well, was that the entry from Jerome Powell?
Yeah, that was, he's my pseudonym.
All right, so we know it wasn't Jerome Powell because we also know that he and I need to go to therapy to fix our relationship because I'm still mad at him. So with that being said, that we had 4 people who had the same number, and then we had our tiebreaker question, which is what decided it. Okay, so obviously today is November 29th. So I'm going to read the 4 names or the 3 names, and then you announce the overall winner based on the tiebreaker.
Actually, there's one person who came just a little bit off. You might want to throw his name in there.
I don't know what you're talking about. All right, I'm going to ignore you right now for 1 second.
I'm used to that.
See where we end up, and then if there's something else you're talking about, which I don't understand right now, then you can chime in again. Okay, so Mark Ardakanian, Dave Loist, Elliot Eisenberg, Dr. Elliot Eisenberg, one of our esteemed guests, and
that's the one.
They all guessed the right number, or not the right number, the same number. Okay, and then but they were off on the date.
Yeah,
announced. So
all they had to do is go and Google what the
hey, don't even start. Okay, it is what it is. Okay, so Kevin, because this was your idea, and thank God you threw in the tiebreaker because that really did decide this. You tell everyone who won.
Oh, I get that, Joy. Okay,
yeah, of course.
So the winner with the closest number, and by the way, what is the final number here? It's 726,200. It was a final number, and the guess was 725,000. Again, a hint I gave people was don't end with 000, but she still gave the 000, came in tied, but came in. Fortunately, she listened to the show and knew the date. And Peaches Jensen out of Greater Ventura, a good friend of the show also. So really happy that, and Peaches, boy, you get your name mentioned with Elliot Eisenberg. I mean,
no, Dr. Elliot Eisenberg.
Dr. Elliot Eisenberg.
And by the way, do not dismiss Mark Arcadian. And if I'm saying that right, wrong, sorry, Mark. I apologize if I'm butchering it. I hope not. And Dave Loist. So anyway, and somebody was asking if you can see the numbers. And good morning. Good morning. Okay, we are just finishing up our announcement of our Crystal Mortgage Pros 411 Crystal Ball winner. It was Peaches Jensen out of Greater Ventura. She got the tiebreaker right because we had 4 people who guessed like the same number of 725. Okay. So we're at 726,200. Our high balance, Kevin, is what?
$1,089,300.
Isn't that
That's gonna be
crazy?
huge.
Okay, but I'm just gonna say, I have not done a high balance loan since last year when they raised the high balance loan limit, because the LLPAs are so outrageous that
Yep.
I have to go jumbo on everything. It's
Actually, I immediately called a client who was on the fence about whether they want to refinance, do a cash out refinance. And I let them know that as of January 1st, their loan, which is 965, would be a high balance loan and no longer a jumbo loan. And the rate would be higher if they wait till January 1st, just because the rates in high balance loans are higher than jumbo loans.
yeah, well,
They might
that's
want to move ahead.
a whole nother thing. And so, first of all, okay, so we're going to jump around a little bit here. I want to make sure that we are acknowledging Miss Joseph, who has joined us on the screen.
Hi,
How-
guys.
Hi.
Hello.
What should we call you? Ms. Joseph?
You can call me Julian. We're all family here. I used to be an originator, so I feel like this is a
Wow.
support group.
So
So
Nice.
you all can just call me Julian. It's fine.
Look
Thanks.
at her
Audrey.
title, Deputy Assistant Secretary for the
I'm
Office.
out of, listen, I don't even, there's not even enough space in my bubble for all of this.
I didn't even know
That's
if I was going to be able to get the whole thing on there, but yay, we did. You know, I was telling her one of my favorite things about Julian is that she has had boots on the ground experience in the real world, which is not normal, frankly, for a lot of the people making policy decisions that impact the mortgage business, right? So you graduated from the University of Virginia with an English literature degree.
I hated math. I didn't want to carry the one. I had no desire. Well, they said, do you want to do the sciences or do you want to do math? I was like, let's talk about astronomy. And so, you know, I was like, let's not do any of this. Like, I cannot stand math. I still don't to this day, believe it or not, but here I am. And I literally, really quick, Audrey, I was majoring in English. I was ready to go into public relations, and then 9/11 happened the summer before my senior year. So I was going to go into PR at Amtrak. And because no one wanted to take public transportation, they retracted my offer. So I went back home to Virginia Beach with my parents. Wow. And my mom was like, okay, well, you got to do something. What's the plan? And at the time, her best friend was a loan officer. And she said, I need an LO assistant. I need somebody to help me take all of these applications. So this is like 2003, 2004 timeframe.
Yeah, right after 9/11, I got kind of busy.
Yeah, and that's when I got bit by the bug, and nobody ever chooses this. We just end up here. Like, how did I get here? And
How
that
did you end up in the government realm?
So literally I originated for a few years, then the housing crisis came, and I was like, you know what, as much as I wanted to continue to push through with that hustle, it was just, I had ulcers named after my clients. I was like, well, there's Miss Johnson. That's all of us. I couldn't get, you know, I was sleeping with my laptop in bed. I was like, this isn't working. So I decided to go into home ownership counseling, and I did pre-purchase and foreclosure counseling in Baltimore at the Neighborhood Housing Services of Baltimore in 2009 and 10. So you can imagine I was ground zero for the foreclosure crisis. But that's where I earned my stripes in servicing. And then after that, I went and I worked for the Virginia Department of Housing and Community Development. I don't know, Audrey, I don't know if I'm just cutting all into this, but sorry.
No, but it's good to, this is what we like. We like knowing you're a real person who really understands the mortgage business from the bottom up. Like I started as a processor, you started as an LOA assistant. I think that gives you such an amazing basis for whatever work that comes later. So it is, I think it's great. And don't you have an MBA too?
Yes, I have an MBA in real estate management. So yeah.
So, and then, okay, this is another thing I just love too. So, you know how everyone's like, I'm an amateur photographer. No, not this one. She actually has a photography business. Like, that's crazy. So you are multifaceted, which I love so much. And you are just a bright light. And just so you know, we met each other a couple of times at a couple of different conferences. And I just want our listeners to know, she's a dynamic speaker, but she's really forthcoming. She doesn't beat around the bushes. I ran my list of things I want to talk to her about, and she's like, yep, all good. Except I added one thing at the end. We'll see if it time for it. And if you don't know the answer, it's totally fine. So it will come out of left field. So there you go. Okay, so Peaches Jensen, who is our crystal ball Mortgage Pros 411 crystal ball winner, said Julian is from my hometown area in Maryland. Baltimore Harbor is the best. So that's great. So and someone else is asking, how do we see our guests on the The list, so I don't know about that. We'll see. So, I don't know whether we're gonna publish everyone's guesses. I don't think so. I don't know
Yeah, I
that
don't-
anyone would like that. But, I will say it is on a spreadsheet. It was this, you know how sometimes people have a contest and they pick the winners, like cherry pick them? No, we did not do that. It's literally, here's the spreadsheet, here are the entries, boom, done. All right. So moving right along. So Ms. Joseph, you are, well, we all see your very long title. So you'll probably know the answer to this. So we have new conforming loan limits that were published today. When will FHA start taking loans at new loan limits?
So the mortgagee letter, of course, is going to be based off of what the GSEs publish. Like by statute, we have to calculate our loan limits based on theirs. So just know within the next 48 hours, you will see the mortgagee letter. So, speaking governese, I can't get in front of the mortgagee letter, but it's not really difficult to kind of calculate how we get to our number as opposed to those in the GSE space. But yeah, in the next day or two, you will absolutely see the mortgagee letter that will give you guys all the bells and whistles of what we got going on. So
wonderful. So it's imminent.
Oh yeah. Oh, we have to. We have to publish it.
Okay, that's awesome. All
Now,
right.
you guys, though, FHA, as I recall, only starts taking loans as of January 2nd.
That's usually our window, is that, for
Yes.
implementation. Yeah, we usually start at the beginning of the calendar year.
Versus Fannie and Freddie, we can start doing it today.
Yeah.
Well, as soon as the lenders
They get their keyboards kicked in and punching the number.
Optimal Blue and all that has to be updated. They're all working on it. So just stand by, guys. Watch for the letters from your the emails from your lenders, and that's how you'll know whether that particular lender is honoring them. But regardless, it's imminent. They all start taking them early, because by the time they deliver them into the agencies, it's going to take a while anyway. So we're good. Yeah.
Yep.
Awesome. All right, moving right along. So we had quite the little list. I know.
Okay.
Check. All right. So Forever MI. Let's just go there.
Let's go there.
So as we all know, we used to have. Well, we have MI that never goes away ever, unless you refi. So there's been a lot of talk about that potentially going away and changing, but then we heard some pushback on that maybe. So tell us where we are on that issue, please.
Okay, so everybody knows basically how the MMI fund is supposed to work and how the MIP is supposed to work. So we have a policy discussion that's going on, but there are also budgetary implications whenever you do a cut, okay? So of course, we know that the fund is extremely healthy. I know everybody saw the annual report that came out last week. I don't know, in federal time, it feels like it's been 6 months, but I think it was like 2 weeks ago. I don't know, something like that.
Yeah.
So we know that the fund is extremely healthy. But the way that it works is we can't take yesterday's premiums to be used for the cut, because those premiums were collected for those loans that were originated. So in essence, those premiums have names on them already. So it's not like we can take the excess that's in the MMI fund, take it and say, okay, let's give it to tomorrow's borrower. If we do a mortgage insurance cut, it will be determining what the rate will be for originations that haven't happened yet. So we can't take it from the current fund.
That makes total sense.
It'll literally be us making an adjustment for, again, like you said, Audrey, new originations going forward. So that's the first thing. So we can't take yesterday's money to fund tomorrow's borrower. That's the first thing. And I think that that's a lot of what the confusion is like, oh, there's so much money in there. Why can't you just take that and do your cut? We
100%.
can't, because they're earmarked for those originations. Because let's say, for example, we do have a 2008 again, for some reason, those premiums that are collected would be used to pay those claims, because that was the premium that was collected for that borrower.
Right.
So what we would do for a cut going forward would be determining what the right size premium would be based on the originations that haven't been made yet. So the cut would be for those new borrowers who aren't here yet. So that's what the cut would be. So with that being said, while there are policy decisions, that's the easy part, right? Like we can determine what would make sense for dollars and cents, but also we have to understand that that's revenue for the MMI fund. So inside of a budget year, if you adjust what you project the fund will produce, you have to take it from somewhere else. So here we are in the middle of a budget cycle where we're saying, okay, a cut feels like we should do it right now. But the cut that we would want to do, if we do decide to do one, we don't want to do anything that would insult the industry that doesn't have any impact either. So what we want to make sure that we're doing is that if we are going to do a cut, that it's impactful, but if it's impactful, it's going to cost money. So that's kind of what you have to take into consideration. The other thing is, with us not having a commissioner in seat at the beginning of last cycle, she wasn't there in order to weigh in on what we would have liked a cut to look like. So the fact that she got confirmed in May, which is after the budget cycle, which is typically November, she didn't have the opportunity to weigh in because this year's budget was already baked, done, and dusted. So she wasn't able to weigh in. Whereas right now we're in a position where we're in November, we're hoping Congress passes a budget, which will allow us, if we were to make any cuts, to propose them going forward, because we're now in the budget cycle. Does that make sense?
Yep.
Yes, it
Okay.
makes much more sense than what we've been hearing, which to your
Yes.
point is exactly, there's so much money in there. Why aren't they making a cut?
Yep.
So
Yep.
understanding that you're looking forward
Yep.
and, but how you do projections, I can't even, so don't go there. It's too complicated.
It's so
Well,
much.
the other thing too is, you know,
Go ahead.
in the cycle of things, we're kind of in the fall cycle of, you know, mortgage terms, and we all know that not so good times are ahead. You know,
Mhm.
looking like there might be a recession coming up, and
Yep.
if so, right before a recession is when you want to have the biggest bank built up. Not
Right.
that's what it's for when the bad times come.
Right.
And you know, it'd be like, oh wait, we have so much stored up of wheat right before winter. Why don't we eat it now? No, we have
Yep.
winter coming. You want
Yeah.
to have that bank built up.
Yeah, and the other thing too that I want to underscore for you guys is that there are two factors that help us come up with the capital ratio. It's the forward and the HECM. Now, everybody knows in the past, the HECM was always the anchor. It was kind of the albatross of the MMI fund because it was performing so poorly for years. Well, we're in a different circumstance now because of home price appreciation. So there are fewer claims that are being paid. One, because there's so much equity in the market that's stopping claims from being paid, because a lot of people are selling before foreclosure. So a lot of the projections of how much we would have in losses aren't happening because it's not 2008 and houses are not underwater. So we have that. And the other thing is home price appreciation is what's calculated, you know, as you know, to also mitigate a lot of the losses that we thought that we would have. So when you look at the capital ratio for the actual forward book, it's still high, you know, it's 10-ish, but the average, there's the ratio for the HECM is 22% right now. So when you start blending those rates, that is really injecting, it's putting the MMI fund on steroids, because if for some reason there is a downturn in the HECM, you're going to see that capital ratio dip just like it was before if HECM's were to take a turn. So all of those, the strength of the fund, a lot of it is juiced by home price appreciation of the HECM book. While it's small, it's still significant because that's where the majority of the equity is sitting in the projections.
Well, just to throw it in there, in 2008, there was 19% on average equity in homes, now 58%.
Yep.
So it
Yep.
definitely is helping
Yep.
everything about our market right now.
Yep.
And the other thing that I thought was interesting, in 2007, there were 4 million homes for sale. And right now there's 1.2 million.
Yep.
And so those are huge differences when you guys are having conversations with your borrowers, realtors. Why should I buy a house now? Why is this different than 2008?
Yep.
Make sure you're giving them those facts. Now, I will say that I'm related to a couple people who think that they have, and I quote, called the market and the crash. And I'm like, what are you talking about? And they're so invested in their position. I'm like, I can't talk them out of it. Maybe it's just because I'm like the sister, but I'm like, okay, if I'm having this much trouble with these guys, what the heck is everyone else dealing with? You know what I mean?
Yeah.
But
Yeah.
use
Yeah.
facts, guys. And that's what some of these numbers are all about, is make
Well,
sure
the number that came out today with the conforming limit, that's a huge tell
Yeah.
on where the market at least was going as of September, because in August we saw lower numbers, but in order for the numbers to have jumped this much, we had to have a big September. That meant that, at least as far as Fannie Mae eligible loans go, those values went up, and it went up substantially. Well,
Well,
And
funny you say that, because I actually have a little tidbit on that too right here.
Yeah.
So Case-Shiller came out with their home price appreciation. It was off slightly, like month over month, by like 1%. But FHFA's conforming appreciation. So that's not jumbo loans. Oh, good Lord. That is literally just conforming loans. It was better. And so that's interesting, right? So the lower priced loans are actually, those places are still appreciating. And we're seeing that all over the place, that kind of data. So if you're in a metro area like San Francisco, San Jose, San Diego, places that were overpriced to begin with, I mean, not to begin with, but were really overpriced. Those are coming down a little more significantly, and especially in the higher end, but certainly not crash. And again, we don't look at this month by month. We look at it year over year. And we have always encouraged people to really go back to 2019 if you're doing comparisons, because comparing foreclosure numbers to last year when there was a foreclosure moratorium doesn't make a whole lot of sense.
Yeah, it doesn't make a lot of sense. That's
Right. And
true.
with that, those numbers, we're seeing, okay, so the newest numbers on delinquencies are still holding really steady and really low. Are you guys seeing the same thing on FHA
Yes,
loans?
and we are, but we still understand that, as rates continue to go up, it's limiting the potency of the mod, right? Like, we get it, like the mod is not going as far as it used to. So every day we're having conversations on what can we do in order to help these borrowers, because especially in the FHA situation, with us having to pool with Jenny and repool with Jenny, we know that if you're got a borrower who's at, in the threes, modding them at 5.5 is just not going to get them the payment savings that they need. So we're trying to find creative ways that we can work around that, because of course the GSEs just have a totally different system over there, being able to recast, which we are a bit, we totally get that it's an easier situation for them. But we have to be a little more creative to figure out what can we do outside of the partial claim in order to help these borrowers. I will, though, do a plug that if you guys are still working with states that have half money, I will still say, if they allow you to drop it as a principal reduction, take it as a principal reduction and mod it then. Even if you mod it at a higher amount, at least you're modding a lower UPB, and perhaps that will get you a little bit more bang for your buck than just trying to mod it, and then use the partial claim in conjunction with half, but do principal reduction and then do the mod if you can. We really worked with Treasury when they were approving the plans to encourage states to use half in conjunction with loss mitigation, because then it was feast time and the rates were still at the threes. But I said, we don't know what next year might look like, because I could feel that the market was overheating. And I said, at some point, the rates are not going to stay where they are, and we need half to be used in conjunction with loss mit. It can't just be used for reinstatement. So I think that Treasury is amenable to the states who did strictly do reinstatement to take a second look if their borrowers are still struggling, to see if half can be used in conjunction with loss mitigation to help. But to your point, we're seeing that our seriously delinquent numbers are hovering kind of where it was prior to the pandemic. At the height, I think in like July 2020, we were at like 863,000 borrowers in forbearance. And I think today we're somewhere around like 130,000 maybe. We're still seeing a constant flow of borrowers who are coming in. It's almost literally, we're breaking even at the number of borrowers coming in as opposed to those going out. Right. We're seeing it it's a steady flow of in and out. And we're continuing to have conversations with the industry and with servicers, but there still seems to be a fresh wave of hardship. So at first we were thinking, well, maybe these are the borrowers who were late to the party, right? That just were already delinquent prior to COVID. Maybe that, because the moratoriums were in place, there just really wasn't any urgency to make a decision. And now they're like, okay, my last opportunity is forbearance. But from talking to the servicers, what we're hearing is there are borrowers who are still losing their jobs because of COVID. Like, there's a new wave of unemployment that's happening. And and that's what we're hearing. So we're just monitoring that closely too. But up to this point, we've been really pleased with how the waterfall worked, and the 25% payment reduction and the streamlined options for people to not have to submit like full packages was really helpful. So we're encouraged by what we've seen so far.
No, we were so grateful and impressed by the response to helping people stay in their homes, even during and their loans during that whole mess. And just this, to me, just having gone through the meltdown too. And I always tell people, I'm like, don't you dare call it the Great Recession. There was nothing great. It was a freaking meltdown. That's all it was. It sucked. Yeah. So anyway, but we were all just holding our breath, because who wants to go through that again? It was a horror show, as you know.
Yeah.
And so we were just so glad. So a couple questions.
Sure.
Well, first a comment, which is make sure that everyone is communicating with their clients that there is still help available. And if they are having hardship with their mortgages, make sure they're contacting their servicers. And I don't know if you guys saw it, and we're not going to name a name, but a servicer was, how should we put it, reprimanded by the CFPB. The news came out today because they didn't help borrowers during the pandemic, and they weren't forthcoming about people's forbearance options and their mod options, et cetera, et cetera. And now they're paying an enormous fine. And so I think we have talked about this a lot, where there are a lot of borrowers out there who still have that hangover, or whatever you want to call it, from the meltdown, when
Yeah.
you had cause to be worried and scared of your servicer. They were not your friends, and that has
Yeah.
changed, but not everyone has gotten the memo. We keep just shouting it from the rooftops, like, let your people know, do a little video, post it on Facebook, post it on LinkedIn or Instagram or wherever, just letting people know that if you are having an issue, contact your servicer. If they are not working with you, take it up a notch. And
Yeah.
we've shown places occasionally where people can make a complaint or whatever. Help your borrowers be proactive and not be afraid of their servicers. Okay, so I wanted to ask assumable loans. So are you
Yeah.
seeing people using that function? How's that going?
Well, the conversations are definitely intensifying. The history of FHA, typically assumptions were used for divorces, death of a borrower, transitioning the property from the estate to an heir. And there was never that need. It was kind of like that arm's length transaction, right? But what we're finding now is there's so much more equity in the market, and also there are sellers who understand that there's equity in the market. So they're not going to sell it for, the UPB. Like, they're not just going to say, oh, let me just walk away, here are the keys.
No.
Because they are, at least understand that the market is still relatively warm and that there's room to profit. So I think, when you think about the typical FHA borrower, it's difficult for them to make up that bridge, right? Like,
Right.
the sales price minus the UPB is a huge delta depending on where they live.
Right. And how long they've been there.
Yeah, exactly. So with assumptions being a servicing function, we know that we want to be able to offer an alternative because, the market is asking for it. And what would that look like? Also, we are looking at the small balance conversation too, because UPB means unpaid balance, unpaid principal balance. I'm sorry.
No problem.
Alphabet soup. Yes, sorry about that, Catherine. But yes, so when you have a borrower who has a house that's worth $300,000, but they only owe $175,000, but they want to sell it for the $300,000. Yeah, the new buyer can take it that $175,000 at the current rate. But what are you going to do with that additional $125,000 to make up the sales price, right? So I think that there are two things to solve for. There is one, like I said, it is a servicing function. Second of all, you got the small balance issue that is out here about the profitability in order to originate a whole bunch of these tiny loans that are out there too. Plug for our RFI that we have out there for small balance loans.
Request for information, RFI.
Request for information on the Federal Register. We're trying to solve this once and for all too on determining what a small dollar mortgage is, so we can craft some policy around it in order to help lenders feel a little more comfortable and not bleed on every deal that is $200,000 or less. So plug for that, please provide comments. But I think that when we look at the assumptions, we have to figure out what type of accompanying vehicle to finance the difference is there, which I think, assumptions just really hit the radar, probably in the last 60 to 90 days, once the Fed started hiking up the rate. So we're still having those conversations to see what that would look like to move it from a servicing transaction, because right now the assumption is pretty much originating the servicing shop, but you're still using your originators and your processors and your underwriters to do credit quality, right? Just to make sure that they can qualify, right? So we're trying to figure out.
And how much do we get paid for helping our borrowers through that process? How much?
Just understand that we are aware.
Huh.
I'll
Yeah,
tell you, Audrey,
what?
You are aware, and as I've said, you are talking to a person who's a practitioner. We are very aware.
Yeah, okay.
We know that it is very, very low.
Yeah, I mean, and by low, she means goodwill is your payment. So,
It
yes,
is mission work. Yes, I will say
it
is mission.
is, which
It's
we
mission.
know that we do a lot of that on our end, but it is something like, it'd be interesting to have someone come to you and say, hey, look, I can bridge the distance, do the math and see, okay, you're paying MI when you wouldn't need to, and you're paying an upfront MIP fee, but does it still make sense if you're gonna get 2 3/4 rate,
Yep,
right?
yep, exactly. So
Maybe it's a math problem, right?
it's a math problem. Yep.
Okay, walk us through, because I thought this was fascinating. Walk us through how you talk about policy in your meetings and how you come to, like, you kind of back into it, right? Tell
Yes.
everyone how you guys do that. I love it.
Okay, so I was telling Audrey, like, I will come with an idea and then I typically get my program directors together, like over program development, who are, our origination and production folks. And then I bring in Joy Hadley, who does our QA, our lender activities. And then I'll also bring in, our asset management director. And what I do is I tell them to pick my theories apart. I literally say, this is something that I'm thinking about. I need you guys to tell me every reason why this will fail. And that is literally how I create every policy that we've done. One of the things that I really am proud of, prior to coming and assuming the seat, I was at the Mortgage Bankers Association, where I was the associate director of government housing programs there. And prior to that was in Richmond, running their multifamily housing program for the state of Virginia. But anyway, when I was, approached and they made the offer for me to come to MBA to work on their residential policy for government programs, I said, I will, under one condition. I have to work on student loan debt calculation.
What?
And the 1% calculation.
Idea.
So for 3 years, I worked with MBA when I was at MBA. And as a matter of fact, Bob Brooks-Smith had just become the CEO and president. And we were having our annual conference in DC, and Ben Carson was speaking at that conference. And I said, I had just met Bob. He had only been there 3 weeks. I was super intimidated. I was like, oh my gosh, I can't come speak to this guy. He's gonna be like, who are you? But I told him that I had an idea. We had just had the Residential Board of Governors meeting. And I said, there's something I want to put on your radar, Bob. And he said, okay, well, I'm listening. And I said, the student loan debt calculation policy is terrible. When I originated, it killed all of my deals. I was like, and I said that if I was going to take this job, that this would be my pet project. Like, we can work on everything else, but please let this be my baby. He's like, well, this will be your ball of yarn. You can just play with it and work on it. So for 3 years, I was literally pushing the previous administration to change it, because I said, it just doesn't make sense. And I said, and for you guys who might not be aware of it, the student loan debt calculation rule was, if a borrower was in an income-based repayment plan, instead of using the actual subsidized payment that they pay every month, you guys would have to assume 1% of the outstanding balance. So
Nightmare.
If $100,000 student loan debt is what a borrower comes to you with, and they're paying $240 a month in an income-based payment, you couldn't take the $240 to calculate the DTI. You're plugging in $1,000 a month. And I was like, well, if they could afford 1% of the outstanding balance, they wouldn't be on an income-based repayment plan. So what I did, I literally was working with the industry while I was at MBA, and crafted a letter that got 18 organizations to sign on to it. And we sent it to Dana Wade. And that was after 3 years. And he's still like, because student loans was still kind of a sticky topic for the previous administration. They didn't really want to deal with it. But I took the seat on June 21st of last year, but June 18th, the Friday before I started, it became the policy of using the actual payment instead of 1% of the outstanding balance. And to answer you all's question, I really believe that that's what propelled me to be able to take the seat, is because I was like the fairy godmother of student loan debt in the FHA space.
We're going to get you a wand and a crown, okay? Just a little tiara, nothing opulent, okay?
Yes.
Actually, so what's your new ball of yarn?
So wow, that's a great question, because positive rental history was the positive rental history that we just rolled out. That was the new crusade that I took after student loan debt. So once student loan debt was done, I said, okay, well, how can we incorporate positive rental history into underwriting? So that was the next ball of yarn that I took once I actually assumed the seat here. But I think one of the things, I think it's now time to really push for supply, and which is the reason why I wanted to Oh, I'm sorry, Catherine, you use the actual payment that's on the credit report. So you don't have to use the multiplier unless it's deferred and there's no payment, then you plug in 0.5%. It's no longer the 1%. But otherwise, it's the actual payment if the student loan servicer can substantiate what the payment is. Okay, sorry.
Right.
So I think now, Kevin, it's focusing on supply because, I think that we have to walk and chew gum. So while we're doing things with access to credit, people have to have houses to buy because otherwise you're putting more pressure on the market and there's not enough, inventory. So I think that working on the 203K is going to be major because once and for all, and when I give speeches, I say, I feel like 203K is like that term paper, you have to do and it's due tomorrow. And you're like, I'm just gonna go take a nap. Like, I'm not even gonna try this. But it feels like 203K, it would be such a valuable tool if it were more user-friendly.
Yep.
So we're working right now on another RFI, request for information, to publish. We'll probably do it at the beginning of the year after the holidays, because we really want you guys' feedback on this, on what you love and what you hate about the 203K. So I just think that, if we could figure out how to make that program more comparable to the GSEs like Home Ready, I think that for our FHA borrowers who may not be as strong credit wise, that don't necessarily have the down payment that like our sister, programs have, it'll make it feel that the market is not as contracted as it is. There are some properties that just need a little TLC, but first-time home buyers feel overwhelmed and intimidated to pursue them, so they never even touch them. And that makes them feel like the only thing that I can get is either new construction or turnkey, which we're also seeing a slowdown in new construction and subdivisions too. So I just think that 203K is a very good program when it works well. And I think that once and for all, we need to kind of figure out what we need to do to tweak it so you guys feel more comfortable using it and borrowers have a better understanding of how to get to it. So we're going to work on that too.
I think that's amazing. And I think we're in a market now that it is much more likely that a seller would at least entertain a 203K offer, where before there was no chance. And especially in certain areas where, hello, you're losing out to all cash offers, let alone, can you wait while I pull together a home inspector and some quotes and a draw schedule and, but I used 203K back in the day. I took 5 units to 4 units and that relationship that I created has lasted decades. It was the first deal we ever did. Somebody else had botched it. We had 2 weeks to close this thing and got it done. And I am the loan goddess forevermore because of it, even to this day. And so those loans, definitely the geek in me loves them. I love all that. Not everyone does. And especially the fact that you're still going to get phone calls after the loan closes and you got paid and you're going to still keep on giving. It's, it's just part of it, but it's so great for the people that can use it. It's also something that I always look at with regard to, okay, how big of a project is it? Is the consumer, is the borrower even equipped to handle a construction project? Because it's really a construction project. So if you're going to simplify something and make it for something like, paint, windows, carpet, or something simple, I think that's brilliant. I know there's the streamline, but
special.
What?
Do a Home Depot special, can they run in?
That's not the first time we've actually heard that, Kevin, to be honest. That's not the first time we've actually heard that suggestion.
That wasn't an original Kevin Casey thought. No, that's crazy.
You need to do the poor man's trademark and then put that in an envelope and certified mail and send it back to yourself.
Oh, there you go.
The poor man's trademark.
Except now we have it on video that
this is true.
He said it, that it came before him. So I don't know about that. Okay, so can we talk for a moment about HECMs? Just I don't know. I don't do them every day, so I'm by no means the expert, and I'm sure there are people on here who know way more than me. But I know that there were some private money, or not private money, some private companies doing HECMs and that have pulled back, et cetera, et cetera. What are you seeing in the HECM arena right now? Just out of
Well, we're it. The FHA program is, at least to my understanding, unless you guys are hearing otherwise, we're still the game in town for HECMs, to my understanding. We are still seeing, again, as we mentioned, the health of the MMI fund, that they are performing relatively well. Earlier this week, I issued 2 additional waivers. I extended the waivers for HECM borrowers who are delinquent because of taxes and insurance, right? And given that there's no monthly payment for them, typically taxes and insurance are the hardship that we're seeing seniors face. So what we've done is with the 2 waivers, the first is to lift the $5,000 cap for repayment plans, just in case, they're in a high cost area, or if it's taxes plus insurance, $5,000 was kneecapping a lot of those seniors. So we're waiving that cap of the 5,000 with no limit. So the repayment plan can be for whatever. That was the first thing. The second thing was the ability for servicers to be able to front the taxes and insurance in order to bring them current, in order to, to protect those borrowers without them having to come out of their pocket first. So, we extended those waivers as well. So, and while we're not seeing tons and tons of borrowers taking advantage of it, we still wanted to make sure that it was available for those particular borrowers that may be struggling, especially due to the pandemic. We're looking a little bit further about HECM borrowers who may already be in repayment plans that have experienced hardships since the inception of that first plan, to discuss giving them a fresh set of time, basically, I want to say a restart or recast of their 5-year repayment period. So we're looking into that too, because some borrowers, it's not like it's a line of credit. If they're already having a hardship, and something else has happened since the course of the pandemic, we're looking at policy in order to give them a fresh 5 years so we can help them with those payments. So we're looking at that as well.
Well, the other thing I keep waiting for is, think about if we had between 20 and 39%, depending on what number you're looking at, appreciation. Not every state has something like Prop 13 where it keeps a lid on your property taxes.
Yeah.
So I'm starting to hear things out of places like Florida and Texas, where people who maybe they move there thinking, their costs were going to be so much lower, or they live there and their values have gone through the roof, and so are their property taxes. As those bills start to hit and people start to realize what they are up against, I think we're going to need to be paying even more attention to that issue, just to make sure that, you don't want someone to lose their house over property taxes.
Over property taxes. Yep, absolutely. So we're definitely keeping our eye on that, to see that what we can do in that situation in order to help those borrowers. So not a day that we're not talking about HECM in the Secretary Fudge is very invested in HECMs and seniors as well. That's a major priority for her.
Okay, that's really good. We have a comment here. Taxes are extremely high here in Texas. Average tax rate is 2.8%. And I've heard, and it, by the way, is very different depending on where you are in Texas. I've heard even higher rates, which is just, good Lord.
I remember looking in Michigan, and it was like their homes were really cheap compared to California, but their tax rates were the same. Like they were paying the same for what I would be buying a house for, $1 million in San Francisco at the time, and their houses were worth, 200,000, but they were paying an equal amount in property tax to what we were paying. So it really varies state to state. And then also, like I said, some states lock it in like California and some don't. Some have like ways of slowing it down. But I think, and this is exactly where you get the sticky inflation, that tax rate goes up and you're there's nothing you can do about it.
Well, I'm sure you can, start disputing it as private prices level off a little bit, right? There's a process within the counties typically where you can say, okay, it should be lower. So just a reminder to everyone, we have a very busy news week. We have pending home sales tomorrow. We have PCI on Thursday. That is going to be a big, huge inflation number that is going to drive the markets. I'm hearing a lot of optimism about what that number might look like. And hopefully it is a continuance of what we're starting to see, which is inflation seemingly level off a little bit. We'll see anyway. So just keep ever vigilant and don't play around with, because how the rates go up much faster than they go down. We always have much more to lose than to gain in any given moment. So if you have somebody who is expecting one rate. Just be really careful. All right. Really just keep watching. Very important to note, US is playing Iran right now and we just scored. So definitely want to, oh my gosh. So, okay, so Catherine is saying Florida, Texas, and Nevada have no income tax. That's why those states have high property taxes. My question for those states, it's going to be, again, I'm always fascinated by this kind of thing. You know, they've had this influx of people, so presumably their services are going to, the cost for the services that they're going to have to provide to the general public is going to go up. How long will they be able to sustain no income tax? I don't know. I don't have an opinion. I just have a question. That happens a lot, actually. Okay, so here's a random question that came after we had talked. So you tell me whether this is, you know, like even on your radar at all.
Okay.
So we know that the banks aren't doing much, if any, FHA loans because of the False Claims Act issue that was going on. And so I had, somebody asked me whether you thought there would be more enforcement using the False Claims Act. I think they had kind of pulled back on using that.
Yeah. Yeah,
So are you able to speak to that? And can you explain, first of all, explain what that means to the general audience and then. Yeah.
And me.
Yes. So, okay, well, the first thing, and as far as the False Claims Act, prior to the previous administration, there was a particular statute that was in place that if lenders were to have any type of defect with their loans, you know, it could be transposing a number, a suit could be taken up by the Department of Justice as a False Claims Act because it's a federal loan. The False Claims Act has, been a lever for some that, it's pulled a little easier than others. But I would say within the last 5 or 6 years, there was an origination taxonomy that was created for this reason. Everything is not a felony. Sometimes it's jaywalking, so you shouldn't have to go to jail for 25 years for crossing the street when the hand is in your face, right? So I think that there needed to be, that was the first step, was to create that defect taxonomy that created kind of that continuum of remedies instead of everything being escalated either to the Mortgage Review Board or, taken to the Department of Justice to be pursued under a False Claims Act. So that's already in place. It actually was created in 2015 or 2016, but took some time to actually be implemented. And the most recent version, I think, was published in 2019. So that's in place for origination and production. We're currently in the process of creating the servicing defect taxonomy, which is a different animal because, and especially given this environment where we have so many borrowers who are taking advantage of loss mitigation, we want to make sure that, that same level of clarity is there to give lenders more confidence that, this is not a gotcha exercise. The one thing that I can speak for is this administration, particularly in the leadership that's here, including Secretary Fudge, has been very vested in, first of all, we want to thank our IMBs so much for continuing to do endorsements. I think maybe 91% of our endorsements come from independent mortgage bankers,
there
right?
You go.
So,
very good.
So IMBs have carried us since, in essence, the beginning of the housing crisis in 2008. But what I will say is there are some efforts that are being made in the depository space. Chase, for example, has over the last year done a lot as far as like dropping their minimum credit score. They've done something similar as far as to address just kind of the stigma of FHA buyers coming to sellers, that they've created, I believe, a $5,000 30-day guarantee that if they pre-approve a borrower and they don't close within 30 days, they'll give the seller $5,000. Like, they are really pushing to help in that space too. I think that a lot of the clarity that we have provided with the origination taxonomy has helped alleviate some of that, because now there is actual policy documents that are in place that if you do transpose a number, it gives you the opportunity in order to remedy that instead of, automatically indemnification is not just like buy the loan back because there's this problem. So
Thank you.
I think the fact that we are putting things in place in order to give people the rules of the road instead of using policy as enforcement is giving people a little bit more peace of mind. And of course, the MOU between HUD and the DOJ is still in place. That was established a couple of years ago. So this is not it's not the agency of yesteryear where it's, anybody who wants to do FHA, off with their head. I can speak for our particular class here that we thank you for your business. And what we don't want to do is anything that will alienate you. So that comes down to down payment assistance, which I will jump in there really quick and say, Commissioner Gordon, I know that a lot of you know her and are familiar with her and her advocacy chops. She is a consumer advocacy attorney by trade. So her heart is in advocacy for consumers. So, and I already told you guys kind of where I came from and what my situation is. So from the purpose of DPA, just understand that at least speaking for us, we have absolutely no intentions of doing anything that will make you guys accessing the resources to help your buyers any more difficult. So you heard that.
That's so great. I mean,
40%.
honestly, the whole point is okay, can I just tell you, there's a sports bar across the street from my office.
Yeah.
And I can tell what's going on.
You're hearing them cheer.
Yes. I have one bar downstairs. I have a sports bar across the street, and I'm hearing these massive waves of
Go! Are you hearing go?
Yeah.
That's
so
awesome.
I think things are going well. Yay.
They're not cheering for me saying that we're not going to get rid of down payment assistance.
No, but we're cheering for you 100% because the whole point is, like, those of us who are in the mortgage space, I mean, most of the people I talk to, we're really invested. We want to take care of our clients. We're concerned when there's over regulation and there are things like, trying to punish someone for an honest mistake, because those costs trickle down to the consumer ultimately. It doesn't matter. You think you're going to nail that lender? Guess who's paying? The consumer, 100%. So being thoughtful about how you use enforcement actions is great, right? And also being clear about what you expect. I mean, and then nail the crap out of the bad guys. We're all for that. So, like, let's get rid of those and then focus on working together to help the consumer. That's all we want. So
absolutely.
Anyway.
Common sense policy, and that is the one thing that I have tried to do, and hopefully you guys have been following a lot of the policy that's come out of the shop over the last year, almost two. But my goal is to put things that are in place that if for some reason at some point we know I will not be here and I will have a successor, that there will not be an appetite to undo anything that I've done. I've tried to approach policy making with common sense and things that I think are germane to the time. But also there are things that there are policies that I want you guys to know are sovereign and are stable, that if this is what you were basing your business on when I was here, that you're not going to have to worry in 4 or 8 years that my successor is going to come in and say, okay, new sheriff in town, this didn't make sense, we're scrapping this. So because you guys need that level of stability as well, in order for you to continue to even start doing business with us and to continue doing business. You don't want to start it one way for only 3 years from now, 4 years from now, for somebody to turn around and say, we don't agree, open up your books.
Right. It's one of the hardest things, I think, in our industry in the last 10 years is there is this whipsaw, or that's how it feels between administrations. And I wish, and I hope, and I pray that mortgages can become less political, because they shouldn't be. I mean, they should really just be 100% about how are we serving the consumer? How does this help them? Not, we're going to fine you and make an example out of you. And, I mean, there is some value to that on occasion. And when I see people who are repeat offenders, I'm angry. Because why are they back? Why are they here? I want to get rid of the bad guys, people, they, thems, whatevers. And I want to keep the good ones, but then let's work together, right? That's what, and it seems like you are so on the same page with that. And if that is the overriding tone at FHA. Thank God. That's awesome.
We're
Okay.
trying.
Yeah.
And
I
the
have a
one thing,
couple-
Audrey, can I
oh,
say this really, really,
yeah,
really quick?
of course.
I would be remiss to not give a shout out to my team of almost 700 people in the Office of Single Family Housing. When I tell you, and I get emotional when I talk about my people, I have cried full tears, like ugly cry in front of a microphone when I've given speeches. But when I tell you that they are class act people, the career staff that has been there, they've been working through the course of the pandemic, they've been missing their children's recitals and soccer games and whatever, to make sure that policy gets done and it's rolled out on time and that it's comprehensive and it is what you all need. And so the next time you talk to somebody, whether it's through the NSC or if you're talking to somebody, that's the National Servicing Center, sorry, or you're talking to someone, the National Resource Center, tell them thank you. Like when I tell you that these people are working and burning the candle at both ends, especially a lot of them are remote. And I've met maybe 15 members of my 700 team staff because we've all been remote. So I've been running this ship virtually since I got here. So, but I say that to say, while I can come up with the ideas, none of this stuff would be able to see daylight without the professionals that are in the Office of Single Family. So just know, if you ever come across them, let them know that their DAS loves them and that I told you that they're.
Oh my God, you're like Tony Bennett. You are the head of the show, but you are making sure that you're highlighting the band. So I love that about you. That's wonderful. Okay, quickly. So first of all, there is a call to action. I just want to mention this briefly. There's a call to action that NAM is doing, National Association of Mortgage Brokers. They wrote a letter to FHFA asking them to please reconsider the LLPAs that are being applied currently to second homes, and then also coming up very quickly to cash out refinances, which is going to have a huge impact, probably negatively, on the consumer. So they have sent that letter. There's now a call to action. We're going to put it on our website at some point, hopefully today, where you just be able to go there, click, and it literally takes like 30 seconds to click, and then just have your voice heard. It's also on the NAM website. I don't know if they've moved it to the front. It's buried deep into their legislative advocacy tab right now. So at the very least, we'll have it on ours shortly, but please be a part of that conversation by at least participating in the call to action, because these LLPAs are out of control, in my opinion, with FHFA, and I'm really happy that the National Association is addressing them. So be on the lookout for that. Our website, by the way, good Lord, we have one. It's a miracle. Thank you again to Julian. You have no idea. We started this during lockdown, and it is.
I don't know if you know, Audrey, but I work at FHA, so technology is not necessary.
That's right. Oh, you guys are you're at the forefront, right? Well, we're right there with you. So we have this kind man, Jason Bellevue, who has taken it upon himself. We now have a YouTube channel. You can watch our videos later, which people are utilizing all the time. And so it's really been awesome. So you can go to our website, www.mortgagepros.411.com, and you can register for the weekly updates. You can and then we'll post this. It'll become more and more robust as we go forward. Okay, we're going to run out of time, of course. I want to quickly ask you, credit scores. Are you going to follow FHFA with regard to, are you going to start looking at Vantage scores? What are any thoughts, or how are you guys?
We haven't made any determination yet on that, Audrey. I think what we want to make sure is that any decision we make, we want to make sure that FHA borrowers are not negatively impacted by any decision. Yep. I think that FHA borrowers tend to be the most vulnerable. So anytime that there's a policy decision, whether it's through scoring, if we're talking about, the MIP, or we're talking about, anything that involves pricing or underwriting, they tend to be the most affected. So what we'll take a look at is, what are the impacts, and is the juice worth the squeeze? Like if we were to do something like that, but it's going to hurt more borrowers, we're going to do a risk analysis first, just to make sure that it's not something that would just inadvertently hurt them. And if that's the case, then we would probably pass. But
how long does the average risk analysis take at FHA? Do you have any sense?
Well, I think it depends on just how large the policy is. Like you're talking loss mitigation. Yeah. I mean, that one we're really going to split the hairs and sharpen the pencil. I think we did it similarly with the positive rental history. We wanted to understand, like, to try to get an understanding of how many borrowers would benefit from it. But we're always looking at the net loss. And if it's a situation where any policy is going to make it harder for FHA borrowers, then likely we're going to be like, nah, this isn't worth it shrinking the book. Our goal is to expand the footprint, not to shrink it.
Yeah, this, you know what, this kind of reminds me a little bit about conversations with VA where they are so focused on the borrower. I love it. It's like, they just want everyone to be healthy and okay in the end. And I love this vibe here too. Okay, the last thing quickly, appraisals. Any thoughts around doing, somebody asked whether you're looking at some sort of version of PIWs for FHA.
Right.
Want to talk about that for 10 seconds?
So really quick, again, we just have to understand that in the price point that these borrowers are in, that the likelihood of them being derelict or having any issues or their ability to absorb any type of defect, it impacts an FHA borrower totally different than it would a GSE borrower. Now, with that being said, are we looking at how we can use technology better? Absolutely. But FHA borrowers, waivers tend to be a situation where if we're wrong, that borrower is stuck, and we just want to make sure we don't do anything to hurt them in that situation.
Would you be willing to come back in a few months and see us again?
Absolutely.
Yeah, we would love that, because I want to talk at some point about some of that, and that would be a great conversation. So we are at the top of the hour. It goes so fast. It's crazy. You've been amazing, which we expected, frankly. I mean, no surprise. Yeah, we loved it. We are, join us next week. We're going to have Rob Christmas on. He's a good friend of ours. And so it's always
a great time.
Oh my God, it's so funny having him on. So anyway, Rob Christman next week. Make sure you share this with your friends. You can catch this on YouTube again. And Julienne, thank you from the bottom of our hearts. We so appreciate it very much. You got great conversation or great comments here. So people loved it and really appreciate you. So with that, we will say goodbye. See you next Tuesday at 11 a.m. Pacific time, 2 p.m. Eastern time. And you have a lovely
USA.
Woohoo! Go USA. Exactly. All right.
Thanks, guys.
Bye, guys.
Take care. Bye-bye.
Bye.